It's time for another edition of the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. And right now, here's Nick and Becky.
Well, hello there, Becky.
Good morning, Nick.
Good morning. All right, so we're here we are. Can I retire now? I don't know what episode this is, but we are getting near year end.
Okay.
So I thought it would be prudent to discuss year end, like a financial checklist, if you will.
Oh, okay. Great.
Like just things that are specific to year end that you want to know if you need to do it by December 31st or if you have a little extra time.
Okay. Yeah. So I don't know anything. So
You don't know anything?
I mean, this is horrible. I mean, I've listened to everything you've talked about.
Narrow it down. We've only been doing this over a year.
Yeah.
You still know nothing? Man, I got to get better at my job.
Or I need to get better at memorizing these things. So
I was going to say paying attention, but that felt a little personal. That's fine.
Okay.
That's fine.
Okay.
That's fine. All right. So this is kind of what I had in and honestly, it's brief. Year end, I think if you address it, it could be very clean, the kinds of things you could do before year end. And then really the next deadline is what is the tax deadline.
yeah, and that's important because it's a busy time of year. So what do we have to do versus what do we give a little more time for?
Bingo. And
Okay.
I think, with the holidays and everything, a lot of times financially, things just kind of fall to the wayside. So
Yep.
let's cover kind of the big ones, right?
All
So
right.
first one on my mind is retirement contributions, right?
Okay.
We deal with retirement all the time. Everybody's saving.
We should be doing that every month, though.
We should be doing that every pay period at your
Mhm.
401k or monthly contributions. But as we get near the end of the year,
Mm-hmm.
all retirement accounts have a maximum you can put in a given period, in a given, let's call it tax year,
Okay.
because tax year is not necessarily the same as calendar year.
That's true.
Okay. So
Okay.
calendar year, just to be clear, is January 1st to December 31st. Something has to be done during those dates.
Mm-hmm.
Tax year, a lot of times you can do stuff next year and it still affects this tax year.
Okay.
I know.
Taxes have their own rules.
Yeah.
They don't follow calendars.
And I promise you, this is not going to be a tax heavy episode. I know how you get, and I don't want to do that to you.
Okay. right.
So retirement contributions. So let's talk about the big ones: 401ks, 403bs, 457s, like your most common ones that you're going to have employer sponsored. I'm also going to throw in simple IRAs. If you remember from our small business retirement planning episode,
I'm going to say yes
which
and smile.
Yep, there you go.
Okay.
Yeah, it's a pretty face.
Yeah.
Simple IRAs get included in that as well. All of those accounts,
Mm-hmm.
your contributions, if you're going to make contributions for 2025, they need to be made in 2025.
Okay. That's a calendar year thing.
That's a calendar year.
Okay.
The moment you make a contribution January 2nd of 2026,
Too late.
that's for next year. It's
All right.
not going to affect it. So all the maximums, all the deductions, all that stuff is in year.
So what doesn't follow this rule?
IRAs, so your traditional IRAs, if you're
Mhm.
making IRA contributions either individually or for a spouse, Roth IRA contributions, SEP IRAs from our small business episode,
Sure.
and HSAs, health savings accounts.
Okay.
They can all be contributed to the tax deadline, which is normally,
April 15th.
there you go. And if you file an extension,
October 15th.
I am so proud
Not
of you
just
right
looks.
now. Wow.
Okay.
Wow. I am so proud. So let's say, for example, you want to make an IRA contribution. Traditionally people are going to do their taxes by April 15th. You have until April 15th to make the contribution for last tax year.
Wow.
So if you needed that extra deduction, or let's say you didn't fully contribute to your Roth, and now you're in January or February of let's just keep it clean, 2026, you can actually contribute for 2025. And then do that first before you move on to 2026.
Okay.
Definitely comes in handy with traditional IRAs, SEP IRAs, and HSAs that are deductible.
Mm-hmm.
And then let's say you're a small business owner and do a SEP IRA. It is very common for our small business clients to file tax extensions.
Mm-hmm.
So that means we sit here today in 2025. if someone files an extension and doesn't have to do their taxes till October of 26, they could actually make their SEP contribution in like September of next year for this year. I know.
If you say so.
It's just cash flow management, I think, for a lot of those cases and small business owners. But I think for individuals, think about April 15th. Know that you could still make contributions for this year, even as we roll into next year.
Okay. So look at your retirement contributions and max them out if you can and need to before December 31st, depending on the account type.
And then if it's an IRA, Roth, HSA, or SEP, you have until you file your taxes.
Nice. Okay.
Not bad, right?
Not bad.
Okay. More year-end stuff. So that was retirement accounts.
Mm-hmm.
Let's talk about contributions for retirement accounts. Let's talk about distributions.
Yes.
Taking money out.
Yes.
Big one that's really the one on everybody's mind when they're retired is required minimum distributions. Or we call them RMDs.
RMDs.
Okay. So I'm sure you remember this. I'm just going to say this for the audience, that if you're not taking your RMDs yet, if you're not of age, then you're going to be required to start taking money out of all of your qualified IRAs, 401ks, all of that at age 73.
All right.
Or 75 if you're younger. Like our age will actually be 75.
Okay.
Yeah. So if you are, let's say going to be 73 next year, you're going to have to take out your RMDs by year end.
Okay. That is a must do.
That is a must happen by year end.
Yes. Or you get penalized.
Okay. You do remember.
They charge you.
Do you remember how much?
I am going to say 10%.
Times 5.
50%.
50%. It's actually the largest tax penalty if you don't take your RMDs out in time.
Wow.
So you need to make sure you take out your RMDs, both for your own accounts or any inherited IRAs you have.
Oh.
By year end, make sure you get that money out so you don't pay that extra penalty.
Great.
Another thing to consider is if you're charitable, if you're you want to give money to a church,
That's
a not-for-profit.
Yeah.
There are things called qualified charitable donations or QCDs that are basically ways we can donate money from IRAs directly to the non-for-profit without having to actually take the money out, pay taxes on it, and then donate the difference. And those have to be done in time to get.
Here's a real niche thing. Can your RMD be a QCD?
Yes.
What?
Yes. And in fact, Becky, oh my God, I maybe have never been so proud.
Your required minimum distribution, you can just make it a charitable donation and not pay taxes on it?
I got to say, this is, other than our wedding day, this is the most beautiful you've ever looked to me. You are absolutely right.
Look, every now and then all the brain cells start firing together.
Wow.
And things happen.
Somebody had her coffee this morning.
Yeah.
So yes. So let's say you're in retirement and you're fortunate enough to have enough income from Social Security and pensions or whatever the case may be. And now you're 73 and it's like, oh, I have to take out money out of my IRA. I'm going to be forced to. But you also happen to be, someone who gives every year.
Yeah.
You can absolutely use your RMD as that qualified charitable donation and ship it right to a charity or not-for-profit, no taxes.
What a gift.
Man, we might have to cut this episode early. She is on fire today. So charitable donations, RMDs, absolutely by year end.
Okay.
No brainer. Couple other just random thoughts I put down. Tax loss harvesting and capital gains planning.
I've heard all of these words before.
Yeah. Tax loss harvesting, one of your favorites.
Yes.
So as a reminder, and we covered this in previous episodes, but as a reminder, that's for non-retirement accounts. So for retirement accounts or non-retirement accounts, sometimes we call them non-qualified accounts. If you have any gains or losses that are realized, meaning you sold the thing. You had IBM stock, you sold it. If you don't sell it, nothing to worry about. But any transactions you've done where you have sold holdings, the difference between the gains and the losses, so if you have 50,000 of gains and 20,000 of losses, that net 30,000 becomes a taxable event at year end. So before we get to year end, now this year has been a pretty good year for the market. Last year was another really good year for the market. People may not have tons of losses.
Yeah,
to counteract
qualify,
these gains. But there are occasions where you may have losses. It may be worth selling something at a loss to write off some of those gains
Yeah.
and then just reinvest that money.
Ooh,
Yeah. And then if
that's
there,
a good tip.
and I think in counter, if you have something that has a lot of gains and you want to sell it, maybe sell some of it in December and sell some of it in January, like straddle the tax year.
Oh, yeah, because you don't want too many losses, or you may want to play it forward if you think
Or too many gains. That would
too
be
many
taxable.
gains. Yeah.
So
Okay.
you may want to split those up depending, talk to your accountant, talk to your advisor. But let's say depending on your income, you may want to shift some of that intentionally to the next year or straddle a certain tax year.
Okay.
But one thing I wanted to bring up about this is a lot of people will try to do this and mess something up. So let's say we get to the end of the year. They say, oh, I bought NVIDIA, Meta, any Tesla, something that's made a lot of money for them over the last couple of years. They go, I want to sell it, but I still want to own it. So I'm going to go ahead and sell it.
Yeah.
Lock in that gain or, whatever.
Great.
And then I'm just going to rebuy it tomorrow because I want it. I want to own it, but let me go ahead and maybe pay my taxes on those gains or take a loss and then rebuy it.
Mm-hmm.
There's something called the wash sale rule.
Wash sale rule. Tell me more.
Wash sale. It means you bought and sold the same thing within 30 days. Or let me rephrase that. Sold and bought the same thing.
And let me guess. The government doesn't like that.
Government doesn't like it. Specifically who?
The IRS.
The IRS. There we go. Man, this is it, guys. This is the pinnacle right here of Becky in action. I love it. So
I got some real low benchmarks, but okay.
Oh, yeah. That's it. No, I'm just kidding.
Okay.
So just know that if you do plan to sell something and you do want to still own it, wait 30 days. You have to exceed 30 days between the sale and the buy so that you could still harvest those gains or losses and then rebuy the holding.
Okay.
So just something to throw in there. I think year end is also a really good time to consider your tax withholdings. So say out of your paycheck, like how much is actually being withheld. Now, it does get a little easier sometimes once you do your tax return. So roll into next year because you'll know if you owe or got a big refund.
Yeah.
But if you look at the end of the year, you're going to have a really good idea of what your income is for the year, what was withheld. And then, of course, when you do your taxes.
If it was enough or too much.
Yeah. And if it was way too much, adjust that. Obviously, if it wasn't enough, adjust it with your W-4 withholdings at work. But if it was too much, that's money you just let the IRS borrow all year, earn interest on it, and then maybe they gave it all back to you. Maybe. I'd rather have that money in our pockets so we can do something with it throughout the year. And then the last year-end thing I thought of was Roth conversions. I get asked a lot about converting traditional IRA money to Roth IRA money, taking something that's going to be taxable when we take the money out and converting it into something that's going to be tax-free. And I think it's a great strategy.
Mm-hmm.
But that is on a calendar year-by-year basis because it is a taxable event. Moving the money from an IRA to a Roth, it's going to fall within the tax year. Within the calendar year for taxes.
Okay.
I know that I just garbled right through that.
No, it's okay. I'm nodding along.
Yeah, I'm looking at your face though, and your face went from all of this stuff you knew to what did he just say? So what's your question?
No, I don't have a question. I'm agreeing with you completely.
Oh, is that your green
Get those
face?
Conversions in by the end of the year.
Yeah. And so again, here's a tax planning kind of strategy. If you're retired this year, let's say late in the year, you probably are not going to do a Roth conversion at the end of the year because you're just going to tack extra income onto an already high income earning year. So it's something to consider.
Mm-hmm.
But now you have the entire year of what happened this year. What gains did we have? What financial transactions did we have to really have a better understanding of if it's going to make sense or not.
So this is really something to talk to an advisor about to see if it makes sense to do it.
Yeah.
This year.
A lot of people think instinctively to do it the year they retire. And a lot of cases, the year after they retire is a lot better.
Yeah.
Because you're a little more control of your income and maybe it's a little lower normally when people retire. Maybe it's not all taxable. So now your taxable income might be significantly lower.
Okay.
And then something like this would make sense. But that is something you do by year end. If you do it in January, That's next year's taxes. We'll worry about that.
All right.
Okay. So retirement accounts,
Yep.
401ks, simple IRAs are year end. Roth conversions, year end.
Mm-hmm.
Tax loss harvesting, year end.
Required minimum distributions.
And qualified charitable donations.
Yes.
All year end.
Year end.
This is 12/31. They have to be done to qualify for 2025.
This year. Okay.
This year. Things that you can roll your decision making into the tax deadline or when you file your taxes would be Roth IRA and traditional IRA contributions, SEP IRA contributions if you're self-employed, and HSAs.
All right.
Okay.
It's a good checklist.
Not terrible, right?
No.
As we roll into the end of the year, if these things apply, it just kind of gives you an idea of what do I have to really make sure I take care of before we go party for the holidays, and then what can roll into.
Or more importantly, before your advisor goes on vacation and can or can't help you if you need help.
Traditionally speaking, the last 2 weeks of the year get real quiet at Wall Street in particular.
Yeah.
So advisors tend to follow that methodology. Yeah. We even kind of soft close.
Yeah, I mean, you still do
Christmas
business
and New
though,
Year's.
but yeah.
Yeah, and so what we always try to do is prioritize these things so they're done before we get to December. That way, we're not stressed. Clients aren't stressed.
Yeah.
But especially if you're doing this on your own or you don't have that kind of proactive relationship, say with your investment person, be aware that these things have
deadlines.
Firm. I'll go with firm. Firm deadlines. We'll go with firm. All right. So these are a couple little things: reduce stress, help lower taxes, support your long-term planning. Any questions?
I think you covered it all, Nick.
Okay. I know I kind of, you know what I didn't do for this episode? I didn't come up with a fun fact. I was so reliant on you for fun facts. I don't really have a fun fact. Do you have anything you can think of that's year-end related? Any fun holiday? You have any dad jokes or something? I'm going to put you on the spot.
No.
Okay.
I don't.
You know what?
I did not prepare anything because these were all topics that are your domain.
My domain, but you knew all this stuff. I was so impressed. So be like Becky, learn, and chime in for next episode, which I'm sure you'll have a fun fact for.
I hope so.
Because that episode is all you and all your bread and butter stuff.
All right. Sounds good.
So if you have questions, you can find us online, sunrisewealthadvisors.com. Obviously, we're on Apple Music, Spotify, YouTube. You can find us on social media. Feel free to send us any kind of request for information, stuff about this. But yeah, thank you for listening, and hope everybody has a nice end of the year. All right, we'll see you next time.
Thanks, Nick. Looking forward to your next podcast, and thank you for listening to today's Can I Retire Now podcast. Until next time, for Nick and Becky, I'm RJ Malik.